Hello, my name is Paul Jones, the Fund Manager of the Boston Income Fund, and I'd like to welcome you to our mid-quarter update. As you may already know, the Reserve Bank of Australia made the decision to reduce the official cash rate by 25 basis points to a record low of 1.75% at the board meeting held on 3 May 2016. This is the lowest that the cash rate has ever been. Unlike earlier in the year, the RBA's decision at the May board meeting was not entirely unexpected following the introduction of data to the marketplace towards the end of April 2016 that indicated that deflation was creeping into the Australian economy. Indeed, Governor Glenn Stevens was clear in pointing out that inflation in the Australian economy has been quite low for some time, and this recent release of data was interpreted by the RBA as being unexpectedly low. These results, in conjunction with the ongoing subdued growth in labour costs domestically and low cost pressures elsewhere globally, point to a lower outlook for inflation than previously forecast. The return profile on the units issued in the Boston Income Fund are closely related to the bank bill swap rates, which we refer to as BBSW 30. This reduction in the official cash rate has followed the historical trend in the relationship between the two rates and has placed downward pressure on BBSW 30, as we can see in the graph on screen, which shows the movement of the cash rate and BBSW 30 since 2009. Accordingly, our expectations are that the return on the Boston Income Fund for the quarter ended 30th of June 2016 will be lower than the rate of return reported in previous quarters. Whilst we do forecast a reduced return in the quarters that follow, we do not believe that this reduction will exceed the 25 basis point cut in the official cash rate. Of course, upon the cash rate increasing in the future, the rate of return on the Boston Income Fund will rise in conjunction with it. The RBA board meeting occurred on the same day that the Coalition Liberal Government Treasurer Scott Morrison delivered the 2016-2017 federal budget. Whilst many in the market considered the details delivered in the budget to be somewhat lacklustre or conservative in comparison to previous budgets, there was one important feature announced that will act to regulate the superannuation industry and the investments of those with self-managed super funds. Of particular note is the plan to introduce a $1.6 million cap on the total any particular member of a fund may transfer into a pension account. A tax will be applied on amounts transferred in excess of this cap. The measures to be applied to superannuation are scheduled to commence from 1 July 2017, and members already with a pension account in excess of this $1.6 million cap are expected to have this balance reduced within the cap rate by this date. Given the budget has only just been delivered, and there are 14 months until these particular changes will be applied, there is still some time to carefully consider these recommendations and assess the impact that they will have on investors. Currently, there are mixed opinions on how the prescribed changes are likely to affect the SMF sector. However, Boston Managed Investments Limited will continue to monitor the area and discuss the likely impacts with advisors that are close to the industry. We hope that this commentary has been of benefit, and as always, if you have any questions about this statement or if you wish to discuss your investment in the Boston Income Fund, please feel free to contact me on 02 89 20 8886.